So today I'm going to be talking about is private equity in trouble? Now this is a very interesting topic because at the moment there are a lot of different very opposing views. And recently I heard a podcast on this and that made me curious, so I did more research. So let's start off with the basics. What is private equity? Well, it's just investing in all private companies and all assets that are privately owned and not listed on any public stock markets. So the way private equity firms work is that they raise funds from institutional investors, for example, pension funds and university endowments, and then they pool all this money together and buy stakes in companies. I'll explain in the next slide in more detail how this works. But their main goal of private equity firms is to maximize EBITDA, which is it's earnings before interest, tax, depreciation, and amortization. And the main way they do this is by buying, improving, and selling companies off for a profit. This has been described as a buy, strip, and flip model, and that's the main way they work. Private equity is very important to the global economy. Like most big companies that you see, approximately 85% on average of our company's assets are privately owned. So yeah, it makes up most of the global economy. And if you want to invest in the global economic growth, you need to invest in private equity. And it's been growing as well for a long time. Like the total value of assets controlled by PE firms exceeded 8 trillion USD in 2024. So some common deal types include LBOs, which are leveraged buyouts, which is where a company is acquired using borrowed money as well as leveraging stakes in other companies. There's growth capital, which is where private equity firms invest in an already mature company and help them thrive even more. And distressed investing, which is where a private equity firm would invest in a distressed company in order to help them restructure. Some major companies include KKR, which is not to be confused with the Kolkata Knight Riders for the cricketers among you, Apollo Global Management, and the biggest one, which is Blackstone. Now let's talk in more detail about how private equity firms raise funds and use this to buy companies. So first, they receive investments from general partners, GPs, and LPs. The LPs generally tend to be these institutional investors, and they act almost like a silent partner. Like they just provide the money. They don't have as much liability or manage the day-to-day operation of the companies, unlike the GPs, which manage the operation, and they take more performance fees and management fees as well. Now, to finance their commitments, both GPs and LPs take loans from the bank, and then the private equity firm would pay the GPs sort of, as I mentioned, a management fee or a performance-based fee. Next, the private equity firm would use this investment money from the limited partners as security for a subscription line from a bank, which is just a short-term loan used to acquire a company. Subscription lines exceeded over 900 billion USD in 2023, which again shows the growth of private equity. Now, the private equity firm would use all of this money to buy the company, but most of the deal value comes from debt financing from the bank, which is simply where a bank loans money to a company, and that debt is then written at the top of a company's balance sheet and paid off over time by profits made. And then the private equity firm would repeat this process a few times to expand on their portfolio. Now let's compare private and public markets in terms of their performance over time. This first graph doesn't actually compare them, it just shows the rise of private equity. So it shows the increase in the total global assets under private management. So as you can see, it's been increasing steadily and sustainably every year, except until about 2022 when it started to plateau a little bit, which we'll talk about later in more detail. Next, we compare the total asset value. So this graph goes from 2000 to 2019, which is before private equity started to plateau, so while it was still on the ascendancy. So as you can see, around 2004, they were fairly even in terms of the asset values, but private equity took off and left public markets behind, which shows how important it is to the global economy. Now finally, we compare the returns. So the light blue bars show the index of your returns if you were to invest in private equity, and the dark blue bars show the index of returns if you were to invest publicly in S&P 500 companies, which are the 500 biggest companies and best performing companies in the US. So as you can see, overall private equity has clearly got much better returns for investors. So overall from these three graphs, we can obviously see private equity has been growing and far outperforming public markets. There are a few reasons for this. For example, private equity has been aided by low interest rates from governments over the last 10 years or so. Additionally, private equity investors seem to have much more understanding and control over their investments. Now, why does private equity seem so attractive to investors? Does anyone have any ideas, potentially? Yeah, we'll go for it.
I guess further returns on the S&P 500 would probably be attractive to investors.
Yeah, so yeah, of course, yeah. So that's the main reason. So they get better returns. And yeah, this is the most obvious reason they've outperformed public markets over the long period of time, as we've seen. There are more reasons as well. So there's access to unique opportunities if you invest in private equity that you wouldn't get if you invested in public markets. Then there's the fact that it seems less volatile than it actually is. This is because it provides better returns, and also because private equity isn't a mark to market. So that means that you can't see the fluctuations every day, like you can see in like the candlestick models in public stock markets. This is known as the volatility laundering problem. Next, private equity, as I mentioned before a few times, it's important to the global economy. Like if you want to invest in most of the world's economic growth, you'd have to invest in private equity. Private equity firms, their main purpose is to improve the business and then sell us off. So this may lead to businesses functioning better as more like well-oiled machines. Now then, some companies have a lower debt equity ratio. So this is the capital structure, or this is the ratio of, this shows the structure of their funding. So debt just refers to borrowed money, and equity refers to money from ownership. So if a company has a low debt equity ratio, that means that they rely less on debt, i.e. borrowed money for their funding, and more on equity. So this would make these companies very attractive for private equity investors because they're not, at the moment, they're not reliant on borrowed money. So they may not be fulfilling their full potential. So private equity firms can swoop in, invest in them, and maybe find a better capital structure. If it was the other way around and they had a higher debt equity ratio, it would be less attractive because private equity firms would think that they're less likely to give returns. Then there's diversification benefits of investing in private equity because private equity is separate to public markets. So if there's sort of a public market crash, this would not affect your private investments. So it would overall make your portfolio of businesses more stable. Then there's the fee structure, which would incentivize managers. For example, the 2 and 20 model, which is basically where the managers of an investment would receive 2% bonus on all assets they own, as well as a 20% performance-based bonus on the profits made by the company. And finally, there seems to be almost a certain like aura or prestige about private equity firms, which adds to their appeal. Now then, let's start to answer the big question. Why might private equity be in trouble? First of all, firms like Blackstone, which is the biggest private equity firm, are worried about the high interest rates. They've been rising since 2021 now. And this is bad for private equity because high interest rates mean that there's less spending, which means there will be less investments and less fundraising for private equity firms. So as you can see from this graph, this is between 2023 and 24. While deal values and exit values have increased in that time, funds raised decreased massively by 23%. Deal volume and exit activity overall fell by 40% since peaking in 2021. Now, private equity in general just peaked in 2021 because they had ultra low interest rates, because this was straight after COVID. So the governments wanted to increase economic activity. And there's overall been less certainty and confidence in the market due to higher interest rates, as well as factors like inflation and COVID. Now, yeah, the reason that high interest rates mean that there's less certainty is because of how much interest rates are fluctuating. You don't know what they're going to be in the next quarter, so you don't know what the value of your returns is going to be. And this, yeah, these points are all linked. So, yeah, as I mentioned, it makes it harder for private equity firms to raise funds. And all of these struggles of private equity in recent years has given rise to strategies to maximize EBITDA, such as continuation funds, which is where stake in a company is transferred to a new fund, and sponsor-to-sponsor deals, which is where private equity firms trade assets between each other. Now, none of this makes the LPs or investors happy because this isn't why they invested in the first place. They didn't invest to see their stakes passed around between competitors or to see them put in new funds. Now let's talk about more stats. So exit deal values in Europe fell by 19% in terms of quarter-on-quarter values, and exit count fell by even more in the same time. So this can cause a cycle. Less exit deals mean that so basically exit deals are how private equity firms sell their investments. So this means that they're not able to generate profits or EBITDA, which then means that they won't be able to give returns to their investors, which makes them, again, less certain and confident. So they'll be likely to invest less and allocate less of their pension funds. This all is also partially due to the bid-ask spread problem, which is just that there's a massive difference between the absolute highest value that a buyer is willing to buy stakes for and the minimum that a seller is willing to sell for. Additionally, experts believe that there needs to be sort of reset in the asset class. Now, this may be in the form of an equity reset or new strategies by private equity firms. This is a very important point, and the reason they believe there needs to be a reset is because in 2021, private equity thrived, and there was an unsustainable and unprecedented amount of deals that took place, and for such high values, that now it's harder for private equity firms to sell the investments they made in 2021 off and get a profit. This has also led to the industry currently having over 30,000 unsold companies with a total value of 3.6 trillion USD. This is bad for GPs as it means they have more liability and are spread more thinly across these companies. And it's also bad for LPs as they won't be able to get their returns because these companies aren't being sold. Now finally, let's look at this table. So this table shows like all the dark blue squares show things that are positive for private equity, and all the lighter blue shows negative things for private equity. And this table overall shows the conditions and how they've been changing. So as I mentioned before, interest rates were ultra low in 2021. It was 0.1%. So there are some negatives we can take from this graph, such as inflation. There's been high levels of inflation every year, which increases uncertainty and shapes government decisions. There's been declining deal counts as well as exit deal values, even though the actual count of exit deals has grown and deal values grew in the last year. Additionally, there's been declining rates of returns. So it was 40% in 2021, and now it's just 4% in 2024, which means that there's less profitability on investments overall in private equity. But at the same time, we can take some positives. For example, LP private equity target allocations have been growing steadily each year, so about 8.3% in 2024. Then there's the median buyout entry multiples, which is the purchase price in terms of a company's EBITDA, and that's been fairly high throughout, and it still remains high at 11.9 times a company's EBITDA, which means that deal values are very high still. So this brings me on to a contrary argument. Why might private equity not be in trouble? Well, the main reason is that even though it's been struggling, it still outperforms public markets. The secondary market, which is where all the sponsor-to-sponsor deals take place, has been performing well. It provides good liquidity and better returns in a short duration. So that's good for private equity firms. Big private equity firms still have over 1 trillion USD in dry powder, which is unused money for investments. So they're not likely to go bankrupt anytime soon, and they still have plenty of money to make investments. And some would argue that the reset required would incentivize private equity firms to streamline their operations and focus on economic sustainability, which would actually be quite beneficial. And next, there are some potential opportunities in Asia. For example, some big private equity firms have been growing in Singapore. Experts forecast an increase in investments in Hong Kong. And South Korea and Japan have high levels of domestic liquidity in their markets. and lower cost of capital because there's lower competition for private equity deals, which drives the prices down. Now we're going to talk about some criticisms of private equity in general. So I've split this into two categories. First, there's moral criticisms, and there's financial criticisms. So the first one I want to talk about is potential antitrust implications due to the roll-up strategy. So the roll-up strategy is basically where a private equity firm takes many smaller companies that are all in the same industry and essentially rolls them up into one much larger company with much more scaled capital and resources, and they have a wider market to sell to as well. So however, this might make a monopoly in the area, as smaller firms won't be able to compete with this massive company. Next, there have been some cases of immoral activity. For example, some dental chains in the US, which are private equity owned, have forced kids to go through unnecessary procedures like root canals in order to drive up profits. Additionally, some Blackstone owned companies have hired hundreds of children. So yeah, it's just horrible. Next, decisions come at the cost of local companies. So if a private equity firm were to buy, strip, and flip a local company, while that would be beneficial for them, because they get to keep the profits from selling it off, it may render that company, it may make them less efficient and not be able to function as well. And yeah, this is similar criticism to vulture capitalism, and it all begs the question: if private equity firms want to increase scale, why buy smaller companies? Why not invest in the S&P 500? Finally, they've had some unfair tax practices, such as the carried interest tax loophole, which allowed private equity fund managers to pay less tax on profits. Now let's move on to the financial criticisms of private equity. So financial critics believe that investors are too exposed to private equity, which is mainly because it's declining, as we saw in the last few slides. Private equity firms prioritize short-term gains, so this may not be economically sustainable, and yeah, they're just trying to maximize their profits right in the short term. Then there's the volatility laundering criticism that I talked about way earlier. And there's too much money chasing too few investment opportunities. So essentially what I mean by this is that there's too much competition for deals, which drives the price up and makes them more expensive. Finally, multiple expansions have grown by 50% due to higher EBITDA. Now, multiple expansions is basically just growth in things outside of a private equity firm's control, such as median asset values, and they're based around things like market sentiments and investors' attitudes. So if they're being prioritized ahead of things like marginal expansions, which is where a private equity firm can control the growth in their company, then this is unsustainable and they may make returns more cyclical and speculative. And approximately 35% deals now are sponsor-to-sponsor deals, which means between private equity firms. This begs the question, how would investment bankers know how to run a business in a different industry? So, as you saw, the moral criticisms were mostly about private equity firms prioritizing profits ahead of people, while the financial criticisms are mostly about the exposure to private equity risks. Now let's talk about an example, Pizza Hut. Who here has been to Pizza Hut recently? Yeah? Michael, did you notice anything different last time you went to Pizza Hut? No? What about you, Alvin? Like anything different to a few years ago? Alright, okay. Yeah. That's an interesting point. But yeah, let's talk about it from a private equity standpoint. So earlier this year, all the way back in January, private equity firm Directional Capital acquired Pizza Hut in a deal that allowed them to control over 130 restaurants around the UK. But some of their policies have been controversial. For example, they've really been cutting down on labor, such as in-house staffing like waiters and chefs, which, while it's reduced wage costs, has also made the operation less efficient in some areas. Then they've also been focusing on dine-in restaurants, which as an industry in general have been falling recently, especially post-COVID, with the rise of delivery services and apps like Uber Eats. So not only may this not be the right move, but it also allows competitors like Domino's to dominate the delivery services industry. And just in general, actually, directional capital has been slow to respond to market changes and slow to invest in tech and logistics, such as the Pizza Hut app. Now, recently, back in October, at the start of our half term, directional capital went under administration, which means that they filed for insolvency because they weren't able to pay off all their debts. So this meant that they had to close down over half the Pizza Hut restaurants around the country, including one in Reading that actually opened only in August on my birthday. So that restaurant in Reading opened in August, and 2 months later, it's being forced to be closed down. The rest 64 are now being managed by Yum Brands, which owns Pizza Hut, Taco Bell, and KFC globally. So these guys actually know what they're doing. And this is an example of how private equity firms, as I just said, the investment bankers and private equity firms may not know how to run a company in a different industry. Well, that concludes my presentation. Thank you guys for listening, and I hope you enjoyed and learned something new.